We are back, and we are on Mondays going to be visited by a reporter from TheStreet.com on a regular basis, and one of those individuals is Chao Deng from TheStreet.com, who's going to be a regular on Money Matters. Chao, welcome to Money Matters. It's a pleasure to have you on.
Hi, Gary. Thanks so much for having me.
You're very welcome, and there are so many things that I want to talk to you about, and you are so knowledgeable in so many areas, so it's kind of a la carte discussion I want to have with you. But let's start with something I talked about on an earlier show where I broadcast on a different station this morning about where the markets are right now and what investors are feeling in terms of taking profits, because the market has gone up about 10%, and at some point you got to take some profits. What is your feeling at TheStreet.com as to what people are worried about and what should they be worried about?
Well, Gary, I interview a lot of investment strategists, and a lot of them throw around the phrase cautiously optimistic. It's a bit cliched, but it certainly describes the sentiment out there. And for viewers who perhaps aren't following markets on a day-to-day basis, I just want to recap sort of where stocks are this year. The S&P 500, which is commonly followed by investors, is up 25% since its October low. It's actually up more than 100% since bottoming out in March 2009. So as you can see, we've really had a strong rally this year so far, and whenever investors see a strong rally, it is very logical to question when a pullback might happen.
So now what also happens is there's a sense of euphoria that hits, and people kind of cast away to the wind the risk factors of the market. And as they put more money into it, they become more euphoric because they're confirming mentally that they're doing the right thing. And that's a dangerous experience, is it not?
Right, and this sense of euphoria, you certainly see that in recent weeks. We've seen some slight pullbacks in the market, but when we see those pullbacks, a lot of buyers come in to buy the dips. And it really just goes to show people are scared that they're going to be left behind if there is a rally.
What I find, and I've been at this for 40 years, what I find, Chao Deng, is that if I am questioning whether or not I should sell a stock, for example, I'll say if I had the cash in my hands today as a result of the sale, would I buy that stock? Because it is as simple as saying sell, and then I have the cash. And if I'm not convinced I want to own a particular stock at today's price, why don't I just wait for another opportunity at another time?
Right. And it's a matter of whether your time span is a long or a short one, of course. And I think that overall, investors are saying that this year should be an up year for stocks, yet they're worried that in the short term they might get burnt. So there is that sort of waiting.
So how do you correlate the fact that the volume on the New York Stock Exchange is low and that the average investor still is not in the market?
Volumes are low, and that probably signals a lot of sort of retail investors staying out, not willing to dip their feet in just yet. And you see some of the day traders and more professional traders taking advantage of the dips in the marketplace.
When I look at corporations and the way that they are hoarding their cash, Chao, I say to myself, if they are not willing to commit their money to investing, why should the average investor not sit on their hoards of cash if they're fortunate enough to have them? What is the incentive for investing at this point in time? Is it the fact we're in an election year and that things might get better? Are earnings from corporations really looking that good? What is the incentive to get off the hoards of cash if corporate America is really not doing it?
Right. There is a lot of incentive, and that's why you sort of see this mixed sentiment out there, buy or stay behind for a bit. Certainly, if you compare the economy to where it was last year, things look a whole lot better. And there is a sense that things are getting better, and so therefore this year will do comparatively better than last year.
So now if you say, well, the market's gone up since October by 25%, is that already baked into the pie?
It's debatable. Last year, we saw that the economy was also turning or was also improving at the beginning of the year, and investors sort of got hit when a lot of the debt problems in Europe really, hit stocks around mid-year. So this year, we're seeing some of the same sort of patterns. Good economic data coming out from the U.S., beating economists' expectations. Manufacturing is improving. Jobs are getting better. Housing, some economists are actually calling for a housing bottom, possibly the beginnings of an improvement. So it's debatable whether all of the points that I've just made are baked into the stocks right now.
Let's talk about a real landmine that's out there, and that's gasoline prices. I was in Arizona this weekend, and I was paying, $4.50 a gallon for gasoline there. I am kind of spoiled because our office in Suffern, New York is on the Mahwah, New Jersey border, so we just drive a mile or so. So I was sticker shocked. Can gasoline prices hurt consumer spending and actually derail the kind of growth we're talking about?
Yes, and it's great that you should bring up your own personal example there, because oil prices are just the great example of what's happening on the consumer side. Most of the economic GDP is made up by consumer spending, and consumers obviously have to drive cars to work. So $4 a gallon gas is can really burn a consumer's wallet. And if you think about how an economy is propped up, it's mainly by consumer demand. So if we see consumers, hesitant to spend because gas prices are rising, you could see overall demand fall, and that in turn sort of turns the cycle, puts a damper on the economy, and then back into stocks, puts a damper on the stock market.
Let's just play this out one other ripple in the pond. It's an election year, and we are probably going to see a lot of promises from the White House to garner some votes. If we're in an election year, have you taken a look at previous presidential election years to determine how the stock market has done? Because at Gary Goldberg Financial Services, we looked at the prior year, the third year in a presidential cycle. Do you have any idea what the fourth year looks like?
Well, the Wall Street Journal actually came up with a very interesting article on this exact topic this morning. And a couple of interesting facts that our viewers or our listeners might enjoy.
All of the above.
So say, on average in a presidential year since the 1900s, the Dow Jones Industrial Average tends to rise about 7.5%. So since we are in a presidential year, as I said, a lot of investment strategists are saying this is going to be a good year. Now, that said, usually what happens is there tends to be some uncertainty mid-year, so stocks can tend to slip by the spring. Once the November elections roll around, some more certainty is sort of put into the outlook, and people start putting money back into stocks towards the end of the year.
So the bottom line, Chao Deng, is to take a look at market sentiment, consumer spending, and, of course, corporate earnings. That really is what drives the market.
And it's good that you mentioned corporate earnings, because we're just wrapping up our coverage of fourth quarter corporate results here at TheStreet. And overall, it was an okay year. The S&P 500 index, which is, an index of 500 important companies, reported earnings growth of about 5.9%. And it's good, although some analysts are quick to point out that if you exclude major companies like Apple and AIG, the earnings growth actually drops to 1.1%, which doesn't look so good.
That really is interesting. The other game that is played on Wall Street, and I've been at it for quite some time, are beating your earnings estimates. I think that beating earning estimates is an overplayed card. You can beat by a penny, but you held some stuff back in giving your forecasts. And I really think it comes down to earnings growth and top-line sales. Last question, are you seeing top-line sales increase?
Well, you're absolutely right. It's more important to sort of look at absolute terms rather than who's beating earnings by what percentage. And certainly on the expectation side, we've seen that companies have missed expectations more in the past. But earnings are continuing to grow, and that's because we're in this sort of cycle where companies have cut back on costs and really sort of strap their belts in order to save and make profits that way. And we're sort of, if we come to the end of that cycle where companies actually have to make money by selling products, making products, as opposed to cutting back on costs, and that could sort of be a game changer.
Could China affect us to any great deal in the event that they are now going to slow down their projected growth rate from 8% to 7.5%?
Certainly, and you hear more and more talk about global economies and how that is going to affect the U.S. stock market more so in this day and age. Just this morning, actually, the Chinese government, overnight, the Chinese government said that it's projecting GDP growth at 7.5% for this year, and that is actually the slowest growth rate since 2004. It's still overwhelmingly fast, 7.5%, if you consider the rate of growth of the U.S. economy, which is projected at only something like 2.2% to 2.7% for this year. But at the same time, China is slowing down compared to past years, and given that it is an economy that just makes up a great deal of the world's demand, it has a major impact on financial markets around the world.
Chao Deng, it's a pleasure to have you as a regular on Money Matters. And ladies and gentlemen, you can go to TheStreet.com for further information and further insightful articles. My goodness, it is a tremendous source of information for anybody who's a serious investor. Chao, we'll talk with you in a week or two.
Thank you so much, Gary.
You're very, very welcome.